Professional scalping does not rely on a confusing array of lagging indicators to generate profit. The most consistent and repeatable one-minute strategy is built entirely upon a deep understanding of market structure and institutional behavior. This video will reveal the exact repeatable strategy that professional traders use to scalp the market, focusing purely on price action. It is a method that allows a trader to enter and exit the market with surgical precision, often within minutes. The core of this powerful approach is a simple yet devastatingly effective pattern known as the Breakout, Retest, and Rejection, or the BRR pattern. This strategy explicitly avoids the common pitfalls of retail trading by anticipating the moves of the so-called smart money. The professional trader understands that the market is a mechanism for transferring wealth, and they position themselves to benefit from institutional manipulation. This is not a strategy about chasing momentum. It is about exploiting the momentary imbalance created by liquidity sweeps. The first critical preparation step for scalping like a professional is the mandatory use of multi-timeframe analysis. Without this foundational step, any one-minute entry will be nothing more than a random gamble against the prevailing current. The higher timeframes provide the necessary context, acting as the professional's compass to navigate the market. This contextual understanding prevents the common mistake of trading against a powerful, overarching trend. The professional's higher time frame rule dictates that the 15-minute chart must be used to identify the overall market structure. This longer view determines whether the asset is in a clear uptrend, a defined downtrend, or a consolidating range. If the 15-minute chart shows a series of higher highs and higher lows, the professional will only look for long trades on the execution time frame. Conversely, a pattern of lower highs and lower lows mandates that the trader only seeks short opportunities. The 15-minute chart is the decision-making map, establishing the directional bias for the entire trading session. The professional never attempts to fight the momentum established on this higher time frame. Trying to pick a bottom in a strong 15-minute downtrend is the hallmark of an amateur trader. The 15-minute analysis provides the structural integrity necessary for high-frequency, short-duration trading. This disciplined approach immediately filters out the majority of low-probability setups. Once the directional bias is firmly established on the 15-minute chart, the professional moves to the execution time frame. The 1-minute chart is used only for sniper entry and the precise management of the trade. This is the canvas where the breakout, retest, and rejection pattern will be identified and executed. It is crucial to remember that the 1-minute chart is prone to noise, which is why the 15-minute confirmation is non-negotiable. The combination of the two time frames provides a high probability edge. The next vital preparation step involves the correct identification of key support and resistance levels. These levels are the battlegrounds where the breakout, retest, and rejection pattern will ultimately unfold. A key level is not just any old wick or closing price. It must be a point that has caused a strong, undeniable reaction in recent price action. The professional focuses on the most recent and relevant turning points, ignoring old, distant levels that the current market has forgotten. To correctly draw a key level, the trader should look for areas where price reversed suddenly and aggressively. Levels that have been tested multiple times and held firm are considered the strongest and most significant. These are the zones where institutional orders are typically clustered, making them prime locations for the liquidity sweeps that fuel the BRR strategy. Clear, well-defined key levels simplify the chart and focus the trader's attention. The professional also carefully considers the optimal market conditions for scalping, which is a high-frequency, transaction cost-sensitive form of trading. Scalping demands liquidity and volume to ensure fast execution and minimal slippage. Therefore, the focus must be on high liquidity sessions, primarily the overlap between the London and New York trading sessions. Trading outside these hours significantly reduces the probability of a successful fast move. Furthermore, the professional trader selects currency pairs or assets that consistently exhibit tight spreads. A tight spread means lower transaction costs, which is paramount when a trader is aiming for small, quick profits of only a few pips. Assets like the major currency pairs, such as the euro versus the United States dollar or the British pound versus the United States dollar, are often preferred for this very reason. The combination of high volume and low cost is a professional prerequisite. Now we move into the exact three-step execution protocol: the breakout, retest, and rejection strategy. This is where the professional separates themselves from the amateur by understanding the true meaning of the market's movements. This strategy is designed to enter a trade after the initial false move, positioning the trader with the market's true direction. It is a waiting game, but a highly profitable one. Step 1 is the breakout, which the professional interprets as the liquidity trap. This occurs when the price moves with strong, undeniable momentum, characterized by large-bodied candles, decisively breaking through a key support or resistance level. The amateur trader sees this strong breakout and immediately chases the move, convinced that the market has chosen its direction. They enter a trade in the direction of the breakout, placing their stop-loss just on the other side of the broken level. The professional, however, sees this breakout as a calculated liquidity sweep, a move designed by institutional players to trigger stop-losses and trap retail traders. This initial aggressive move consumes the available liquidity at the key level. It is a common manipulation tactic that draws in the weak hands, who are now positioned on the wrong side of the impending reversal. The professional waits patiently, knowing the market often returns to retest the level. The amateur trader is now in a position of false confidence, having entered a trade on a strong momentum candle. They believe the market is running away from them, and they feel the fear of missing out, or FOMO. This emotional entry is precisely what the smart money relies upon to execute their reversal. The professional understands that a true, sustainable breakout rarely occurs without a subsequent retest of the broken zone. This initial breakout is merely the setup. Step 2 is the retest, which serves as the confirmation zone for the professional's strategy. After the strong breakout, the price must drift back toward the now broken key level. This pullback is the crucial difference between a professional setup and an amateur gamble. The professional observes the nature of this return move very closely. The retest should show weak momentum, characterized by slow, controlled movement with smaller, overlapping candles. This weak, controlled pullback signifies that the selling or buying pressure from the initial breakout has subsided. The market is not aggressively rejecting the move. It is simply returning to the zone where a large volume of orders was executed. The professional understands that the broken support level is now expected to act as new resistance, or the broken resistance level is expected to act as new support. This flip in polarity is the confirmation zone. A sophisticated layer of professional analysis involves looking for Fibonacci confluence during this retest. The professional will draw a Fibonacci retracement from the swing low to the swing high of the initial move. The ideal retest often lines up perfectly with the 0.5 or the 0.618 Fibonacci retracement level. This alignment provides a strong indication of institutional re-entry, as these are common institutional order block zones. The confluence significantly increases the probability of the entire setup. The weak momentum of the retest is a non-negotiable requirement for the strategy. If the price returns to the broken level with the same strong momentum as the breakout, the setup is immediately invalidated. A strong return suggests a true, powerful reversal, not a controlled retest intended for a continuation. The professional exercises patience, waiting for the slow, controlled drift back to the key level, often represented by multiple small doji or spinning top candles. The professional trader recognizes that the retest phase is the final opportunity for the smart money to accumulate their positions before the true move begins. They are essentially testing the strength of the new support or resistance level. The price must touch or come extremely close to the broken level, confirming the polarity flip. This patient waiting during the retest is what defines the discipline of a professional scalper. Step 3 is the rejection, which is the professional's sniper entry signal. This is the moment the trader executes their plan using the tightest possible stop loss. The rejection occurs when a strong rejection candle prints right at the retest level, confirming that the smart money has defended the zone and is flipping the market direction. This candle is the professional's final absolute confirmation. The rejection candle must be a clear and powerful sign of reversal, such as a large pin bar with a long wick, a strong engulfing candle, or any clear reversal candlestick pattern. The wick of this candle should touch the retested key level and then close strongly away from it, showing an immediate and powerful rejection of the price. This signifies that the institutional orders have been executed and the planned move is now commencing. The entry rule is strict and must be followed without hesitation or second guessing. The professional places the market order immediately after the rejection candle closes. Not before waiting for the close ensures that the rejection is confirmed and is not just a temporary wick that pulls back. The moment the candle closes, the entry is executed, positioning the trader perfectly at the highest probability point. This is the sniper entry demanding immediate action. Let us consider a hypothetical example to solidify the understanding of the breakout, retest, and rejection strategy. Imagine the 15-minute chart is in a clear uptrend, establishing a bullish bias. On the 1-minute chart, the price is consolidating below a key resistance level. Suddenly, a large green, full-bodied candle breaks through that resistance level with strong momentum, trapping amateur traders into a long position. The professional trader ignores this initial breakout, recognizing it as the liquidity sweep. The price then slowly, with small red and green candles, drifts back down to retest the broken resistance, which is now expected to act as new support. This is the weak momentum retest, the confirmation zone. The price touches the level, and immediately a large pin bar prints, with a long lower wick and a strong close back above the new support. This pin bar is the rejection candle, the sniper entry signal. The professional immediately enters a long trade as the pin bar closes, knowing they are positioned with the smart money's reversal. Their entry is at a much better price than the amateur who chased the initial breakout. The entire setup is a textbook example of trading the manipulation, not the noise. This disciplined approach is what generates consistent profits. The alternative scenario in a downtrend involves a strong momentum candle breaking below a key support level. This is the initial liquidity sweep, trapping amateurs into short positions. The price then slowly drifts back up to retest the broken support, now acting as new resistance. The professional waits for the weak momentum retest to occur, confirming the polarity flip. This patience is a form of risk management. As the price hits the new resistance, a large bearish engulfing candle prints, completely covering the previous small retest candles. This is the rejection candle, signaling the institutional defense of the level. The professional enters a short trade immediately upon the close of this bearish engulfing candle. This entry is executed with the confidence that the market has confirmed its true direction, aligning with the 15-minute downtrend. A detailed look at the risk management protocol is the next step, which is non-negotiable for high-frequency scalping. The professional scalper understands that a single large loss can wipe out a week of small, consistent gains. Therefore, the stop-loss placement must be strict, tight, and adhered to without exception. This is the firewall that protects the trading capital. The strict stop-loss rule dictates that the order must be placed only a few pips or one tick beyond the high or low of the mate's rejection candle, or the entire retest zone. If the trade is a long entry, the stop-loss goes just below the low of the rejection candle. For a short entry, the stop-loss goes just above the high of the rejection candle. This tight placement maximizes the potential risk to reward ratio. This tight stop-loss placement is the very reason why the execution on the 1-minute chart must be so precise. If the rejection candle is invalidated by the market moving past its high or low, the entire thesis of the trade is wrong. The professional accepts the small loss immediately, knowing that holding on to a losing trade is the fastest way to financial ruin. The maximum loss is determined before the trade is ever entered. The professional trader must internalize that a tight stop-loss is not merely a suggestion. It is a fundamental pillar of profitable scalping. High-frequency trading relies on the law of large numbers, meaning the trader must take many small, high-probability trades with minimal risk. Allowing a stop-loss to widen or moving it because of hope is an amateur mistake that destroys capital quickly. Discipline is the only difference between a gambler and a professional. The take-profit rule is equally important and must be identified before the entry is executed. The professional does not rely on arbitrary profit targets. They target the next major key level. This key level is typically the previous swing high or swing low identified on the 1-minute or 5-minute chart. These levels are likely points where the market will stall or reverse, making them ideal exit points. The professional aims for a minimum risk-to-reward ratio of at least 1-to-1, but ideally 1-to-1.5 or higher. If the stop-loss is 3 pips, the minimum take-profit should be 3 pips, and preferably 4.5 pips. This positive expectancy is what ensures long-term profitability, as the trader does not need to be right more than half the time to make money. A winning strategy must always protect the capital first. For example, if the professional enters a long trade at the close of a rejection candle and places the stop-loss 5 pips below it, the take-profit must be set at a minimum of 7.5 pips away. The target must also coincide with a clear structural swing high on the chart. If the swing high is too close to allow for a 1-to-1.5 ratio, the professional simply skips the trade. The setup must meet all criteria. The exit clause is a critical professional rule that separates the disciplined from the emotional. If the trade is entered and the momentum immediately fades or the trade stalls for an extended period, the trader must exit the position before the stop-loss is hit. Scalping is about fast, decisive moves, and a stalling trade often indicates a loss of institutional interest or a potential market reversal. This is an exit based on time and momentum, not just price. If the market enters a period of chop immediately after the entry, the probability of the trade succeeding drops dramatically. The professional does not wait for the market to decide. They take the small, break-even, or minimal loss exit. This protects the capital from being unnecessarily exposed to volatile, sideways movement. The professional understands that the preservation of capital is the primary goal of every single trade. This exit clause is a proactive risk management tool, acknowledging that the 1-minute chart is inherently noisy. A successful scalping strategy demands that the trader is willing to be wrong often, but only lose a small amount when they are wrong. Exiting a stalling trade is a demonstration of superior discipline and a commitment to preserving the positive risk-to-reward expectancy of the overall strategy. The trade must move quickly in the intended direction. The professional trader continually refines their understanding of the breakout, retest, and rejection pattern. They do not just look for the pattern, they look for the quality of the pattern. A breakout with exceptionally large volume and a retest with very low volume, followed by a powerful rejection, is a higher quality setup than a weaker, less defined one. Quality over quantity is the mantra of the successful scalper. Understanding the context of the market is key to assessing the quality of the BRR setup. If the 15-minute trend is extremely strong, the 1-minute BRR pattern that aligns with that trend will be a much higher probability trade. Conversely, a BRR pattern that attempts to catch a short-term counter-trend move is inherently riskier and should be traded with a smaller position size. The multi-timeframe analysis is the ultimate quality filter. The professional also pays close attention to the time of day, as this affects the momentum and volatility that drive the strategy. A BRR pattern that occurs during the high-volume London or New York session is far more likely to generate a quick, profitable move than one that occurs during the quieter Asian session. High-volume periods provide the necessary fuel for the sharp rejection needed for a sniper entry. The entire strategy is a confluence of factors. Let us revisit the importance of the Fibonacci retracement tool as the optional professional layer. When the retest perfectly aligns with the 0.618 level, it suggests a deep institutional order block has been filled. This deep retest often leads to the most explosive and powerful move, offering the best risk-to-reward opportunities. The professional does not rely solely on the Fibonacci, but uses it as a powerful secondary confirmation tool. The professional trader meticulously logs and reviews every single trade taken using the breakout, retest, and rejection strategy. They analyze what made a winning setup successful and what caused a losing setup to fail, even with a tight stop loss. This continuous feedback loop is what drives the incremental improvement necessary to maintain a professional edge in the volatile world of scalping. The process of review is as important as the execution. A common mistake made by amateur traders attempting this strategy is prematurely entering the trade during the retest phase. They fear missing the move and enter before the rejection candle has printed and closed. This lack of patience often leads to getting stopped out on the initial volatility that precedes the true rejection. The professional waits for the final undeniable confirmation. Patience is the ultimate discipline in this strategy. Another pitfall is the failure to correctly identify the key levels in the first place. If the support or resistance level is weak or arbitrary, the breakout and retest will likely fail to produce a reliable reversal. The professional ensures their key levels are validated by multiple strong price reactions, creating a robust zone for the BRR pattern to unfold. A strong foundation is necessary for a strong trade. The professional trader also understands that no strategy, regardless of how effective, works every time. The video title refers to the strategy's consistency and repeatability within a probabilistic framework, not a guarantee of a 100% win rate. The goal is a high probability edge that, when combined with strict risk management, leads to long-term profitability. This realistic expectation is part of the professional mindset. The execution of the breakout, retest, and rejection strategy requires mental fortitude and a detached, mechanical approach. The professional treats the market like a machine, simply executing the steps when the conditions are met, without emotional attachment to the outcome of any single trade. Fear of losing and greed for more profit are the two emotions that destroy a trader's account. This strategy is designed to minimize emotional input. The professional scalper must be a quick decision maker, as the 1-minute chart demands immediate action. The window of opportunity for the sniper entry is often very brief, lasting only a few seconds after the rejection candle closes. Hesitation can mean the difference between an excellent entry and a missed opportunity, or worse, a late entry with a poor risk-to-reward profile. Speed and accuracy are paramount. The entire process, from identifying the 15-minute bias to executing the 1-minute entry, must be a streamlined, habitual process. The professional has practiced this strategy so many times that the steps become second nature, allowing for rapid execution under pressure. This level of preparation eliminates the need for complex on-the-spot analysis, which is prone to error. The plan is created before the trade is ever considered. In summary, scalping like a professional is about understanding market manipulation and positioning oneself to profit from it. It is about discarding complex indicators and focusing on the core principles of supply and demand represented by price action. The exact 1-minute strategy that works consistently is the breakout, retest, and rejection pattern, executed within the context of a higher time frame trend. This 3-step process is the key to surgical, high-probability entries. First, the professional identifies the breakout, which is the strong momentum move that acts as the liquidity trap, drawing in amateur traders. Second, they wait patiently for the retest. The slow, weak momentum pullback to the newly flipped key level, often confirmed by the 0.618 Fibonacci third, the professional executes the rejection. Entering the trade immediately upon the close of a strong reversal candle at the retest zone, this is the sniper entry. The success of this strategy is entirely dependent on professional discipline, quick execution, and strict adherence to the rules. The tight stop loss, placed just beyond the rejection candle, is non-negotiable, protecting the capital from unexpected market moves. The take-profit target must be set at the next major structural level, ensuring a positive risk-to-reward ratio of at least 1 to 1.5. The professional never chases the market. Remember that trading is a game of probabilities, and the professional edge comes from stacking multiple probabilities in your favor. The combination of multi-timeframe analysis, key level identification, the BRR pattern, and strict risk management creates an extremely high probability setup. Focus on the quality of the setup over the quantity of trades taken each day. This selective approach is the hallmark of a profitable professional scalper. Now that the complete strategy has been unveiled, it is time for you to take this knowledge and apply it. The only way to master the breakout, retest, and rejection pattern is through diligent backtesting and consistent practice in a simulated environment. Do not rush to live trading. First, prove to yourself that you can execute this strategy flawlessly without emotion for a sustained period. Your success depends entirely on your disciplined execution of this plan. The final piece of professional advice is to maintain a detailed trading journal, recording every setup, entry, exit, and the emotional state during the trade. This journal will be your most valuable asset, revealing your personal strengths and weaknesses when executing the BRR strategy. Trading is 90% psychology and 10% strategy, and the journal helps you conquer the 90% trade the plan and never plan the trade.